You know, I was looking at the calendar this morning and it hit me, we are deep into early 2026.
Right.
And for decades, the whole concept of the flying car was the ultimate shorthand for a future that never showed up. We were promised skylines and Jetsons, sleek pods zipping between
And
spires.
instead, we got stuck on the 405.
Exactly, in a beige Corolla listening to audiobooks.
It's the classic disappointment of modern tech, isn't it? As the saying goes, we wanted flying cars, and we got, 140 characters and the slightly faster pizza delivery app.
Right, but that's the thing. Looking at this stack of research and reports we have on the desk today, that whole cynical narrative is, well, it's dead.
It's over.
We aren't talking about concept art anymore. We are staring at a certified, regulated reality. But we aren't here to talk about just the novelty of it. I want to look at the money.
The money, the warfare, and the software.
Exactly. Because we have financial analysis here, stock performance reports on Joby Aviation, which is currently sitting at a market cap around, $9.6 billion?
Yeah, about that.
And some really aggressive strategic moves involving Nvidia. I mean, this isn't just about aerodynamics or battery density anymore. This is a Harvard Business School case study playing out in real time.
It really is. And the sources we're looking at today suggest we are moving past the can it fly phase.
That's done.
That's done. The physics works. The engineering is proven. The question for 2026 is, who actually survives the business model? Because building a plane is hard. But building a profitable airline with a plane that doesn't exist yet, that is a different beast entirely.
So that's our mission for this deep dive. We need to unpack how Joby is positioning itself against its rivals, like Archer and the very mysterious Wisk,
Yeah.
and specifically why they felt the need to get in bed with Nvidia. Because on the surface, trading at nearly $10 a share, Joby looks like the leader. But I have to ask, is that position safe?
It's a precarious lead.
Or is it a house of cards waiting for a gust of wind?
I think that's the right question. They are the front runner, absolutely. But that deal with Nvidia is the key to understanding why they are terrified of what's coming up in the rearview mirror.
Let's start right there then. Late last year, late 2025, Joby drops this news. They're teaming up with Nvidia.
Right.
To the casual observer or, even your average tech investor, it sounds like press release fluff. Tech company meets airplane company.
Like they just want a recognizable logo on the fuselage.
Exactly.
It does sound like buzzword bingo at first glance.
Yeah.
But you have to look at what they're buying. This isn't about putting better screens in the cockpit or running a flight simulator. This is about the IGX Thor platform.
Thor. Subtle name. Sounds like they are planning to bring down the hammer.
Nvidia doesn't do subtle. Thor is a heavy-duty computing platform designed for what we call edge AI. And that distinction, edge versus cloud, is probably the single most important technical detail in this entire story.
Okay, hold on. Edge AI is one of those terms that gets thrown around a lot in tech circles. For the listener who doesn't code for a living and just wants to know if this stock is a buy, what does that actually mean in the context of a plane?
So typically, when we think of AI, like the chatbot you use to write emails,
Mm-hmm.
all that processing happens in a massive server farm somewhere.
In a basement in Virginia or Iceland, yeah.
Exactly. That's cloud AI. You send a request, it goes to the server thinks and sends the answer back. Edge AI means the brain is right there on the device.
In the plane.
In the plane.
Why does that distinction matter so much here? I mean, we have 5G, we have satellite internet. Can't they just beam data down to the ground to be processed?
Latency. If you're flying a 2-ton vehicle over downtown Manhattan at 100 miles per hour and a rogue drone swerves into your path or a bird strikes a rotor,
You can't wait.
you cannot wait for your data to go to Virginia, get processed, and come back. That round trip might only take 200 milliseconds, but in aviation, 200 milliseconds is the difference between a correction and a catastrophe.
Right.
The decision has to happen instantly, right there on the edge.
So Thor is the onboard brain.
It's a supercomputer the size of a license plate, and it's handling sensor fusion. These aircraft are covered in cameras, radar, LiDAR. It is a noisy, messy flood of data.
Okay.
Thor takes all that chaos and stitches it into a coherent 3D understanding of the world instantly without needing to talk to the ground.
And Joby is layering their own software on top of this, right? The Superpilot.
Correct. And this is where the business strategy gets really interesting. Joby isn't just buying its ship. They're building an entire software ecosystem. They are signaling that they don't view themselves as a hardware manufacturer.
They see themselves as a technology platform.
Exactly.
Which brings up the cost. We're going to get to the financials later, and believe me, those numbers are wild. But building a proprietary software stack on top of top-tier hardware, that is not a cheap way to build a taxi service.
No.
Why not just buy software off the shelf? Honeywell or Garmin must have something.
It's incredibly capital intensive. You are burning cash on coders, on silicon, on testing. But to understand why they're spending this money and why they refuse to just be a plane maker, you have to look at who they're fighting.
The landscape.
The landscape.
Yeah.
The sources identify 3 distinct flavors of strategy in the eVTOL market right now, and they are all betting on different outcomes.
Let's break them down, because I think the general public and maybe even a lot of Wall Street analysts tend to lump all these air taxi companies together.
And they aren't the same animal.
Not at all.
They're radically different businesses. First, you have the manufacturer model. This is Archer Aviation.
Okay, so Archer is, what, the Ford of the skies?
Essentially. Their primary goal is to design a plane, get it certified, build it in a factory, and sell it to United Airlines or whoever wants to run a fleet.
They just hand over the keys, take the check.
That's it. It's a traditional aerospace model.
Clean, scalable. You don't have to worry about managing pilots or dealing with angry customers who lost their luggage or building a booking app. You just sell the hardware.
Exactly. It's lower margin in the long run, maybe, but it's a much lower headache. Then on the complete opposite end of the spectrum, you have Joby, the vertical integrator.
The do-it-all approach.
Joby wants to be the manufacturer, like Boeing.
And the operator, like Delta.
And the ride-hailing app, like Uber.
Yeah.
They would design it, build it, own it, and fly it.
That sounds like a logistical nightmare. I mean, think about the overhead. You have to maintain the planes, hire the pilots, build the vertiport.
Oh, it's immense. Write the software. Why take on all that risk?
Control.
Control. If you own the whole stack, you control the customer experience end to end. You keep all the profit margin. You aren't sharing it with United or Uber. And this is crucial. You own the data. But yes, it is insanely expensive to set up.
And then there's the third player, the one the sources keep calling the underappreciated risk, Wisk.
Wisk is the fascinating outlier. They're backed by Boeing, so they have deep pockets. This isn't some scrappy startup. But their strategy is, it's binary. Joby and Archer are launching with pilots in the seats. Wisk, no pilots.
Ever. Like not even a safety driver.
Never. Their aircraft is designed from the ground up to be autonomous. No stick, no rudder, no human. If you look at the cabin design, there isn't even a place for a pilot to sit.
I can see the problem there immediately. Certifying a pilot is a known process. We've been doing it for 100 years.
Right.
Certifying a robot to carry my grandmother to JFK, that's a different beast.
It is a massive regulatory wall. That's why Joby and Archer are winning the race to certification right now. They can just put a qualified human in the front seat, and the FAA says, okay, we understand this. The human is responsible.
Right.
Wisk is stuck in testing until they can prove the robot is statistically safer than the human.
So if you're a Joby investor sitting here in early 2026, you're feeling pretty good. You're going to be in the air making money years before Wisk can legally pick up a passenger.
You are. You have the first mover advantage. But here is the trap, and this is the central tension of the entire industry. What happens when Wisk does get certified?
Well, they start flying.
They start flying. But look at the unit economics. If Joby is flying a passenger, they are paying for the energy, the maintenance, the insurance, and the pilot.
And pilots are not minimum wage employees, especially not pilots certified for vertical takeoff and landing in complex urban airspace.
Yo.
That's a 6-figure salary sitting in that front seat.
Exactly. Pilot salaries are often the single biggest line item in operating an aircraft. Wisk has zero pilot cost.
So Wisk can just slash prices?
They can undercut Joby's operating costs by 30, maybe 40%. It's the same existential threat that Uber drivers face from Waymo.
Yeah.
If the car drives itself, the ride becomes a commodity. If Wisk enters the market, even 3 years late, they could start a price war that a piloted service simply cannot survive.
This puts Joby in a really weird spot. They have the lead, but they have this ticking clock built into their cost structure. They have to get rid of the pilot eventually to stay competitive with Wisk.
Precisely. They know the pilot is a bridge, not the destination. But you can't just fire the pilot and install software overnight.
The FAA needs proof.
They need so much proof, and that brings us right back to Nvidia.
And the Superpilot.
This is the brilliance of the strategy, if they can pull it off. The sources draw a direct comparison to Tesla here. And I think it's the most important insight in these documents.
Walk us through that, because Tesla is a car company, not an airline. And frankly, Tesla's full self-driving has been coming next year for about a decade now.
True, but think about how Tesla solved the data problem. They didn't just build a robot car and test it on a closed track.
Right. They sold millions of cars to humans.
And those cars had cameras and sensors running in the background.
Shadow mode.
Exactly, shadow mode. The human is driving, but the computer is watching. It's predicting what the human should do.
Right.
If the computer predicts turn left and the human turns right, the system marks that as an error and learns. It uploads that edge case to the central server.
So Joby's trying to do the same thing.
That's the plan. They launch in 2026 with human pilots. They generate revenue. They build the brand. But onboard every single flight, that Nvidia Thor chip is running the Superpilot software in the background.
It's acting as a digital co-pilot.
It's helping with navigation, maybe handling simple tasks like holding altitude. But its real job is harvesting data. It's watching the human pilot handle crosswinds, handle landings, handle bird strikes. It's learning pilot intuition.
That is actually kind of devious. They are paying the pilots to train their own replacement.
It's cold, hard capitalism. But from a data science perspective, it's the only way to win. You cannot simulate the chaos of real-world urban flight in a computer. You need millions of flight hours to train a neural network to be safe enough for the FAA.
And Wisk can't do this.
Wisk can't do it with passengers. They can fly empty test flights, which cost money. They are burning cash for every mile of data.
But what?
Joby gets to collect data while the customer pays for the ticket. Joby is getting paid to train their AI.
So the argument is Joby builds a beta moat. By the time the FAA is finally ready to say yes to civil autonomy, Joby walks in and says,
We have 10 million miles of data proving our software works because it's been flying alongside our ACEs for 5 years.
and then, flip of a switch, they transition to autonomy. They remove the pilot seat, add another passenger seat, and their unit economics suddenly match Wisk's.
Rebang.
Okay, that makes the Nvidia deal look a lot less like buzzword soup and a lot more like an insurance policy against bankruptcy.
It's a survival strategy. It signals that Joby knows the pilot is a temporary necessity. They are planning their own obsolescence.
But there's another angle here in the notes regarding the military, because getting the FAA to certify Superpilot for civilians is going to take a long, long time.
Oh, yeah.
The government, however, usually plays by different rules.
The defense-first strategy. This is a smart tactical pivot.
Yeah.
The FAA's job is to ensure zero risk for civilians. The Department of Defense's job is to get mission capabilities. Their risk tolerance is different.
So Joby wants to sell these autonomous capabilities to the military before they sell them to you and me.
Exactly. They pursue certifiable autonomy for defense applications. Maybe it's a logistics drone resupplying a base. Maybe it's a medevac unit that flies into a hot zone to pick up a wounded soldier without risking a pilot.
It's a sandbox.
It's a paid sandbox.
Yeah.
They get government contracts revenue to test and harden the Superpilot system in real-world environments.
So they can work out the bugs.
And do it without risking the stock price on a civil crash.
So the roadmap is, 1, launch with pilots for the public to build the brand. 2, sell autonomous bots to the military to build the tech. 3, merge them eventually.
That's the double game. And if they execute it, they neutralize Wisk's entire advantage. Wisk is betting on being the only autonomous player. Joby is saying, we'll be autonomous too, right when it matters.
If being the operative word there. Let's look at the financial reality of this, because execution is expensive. We mentioned Joby is trading around $9.90. The market cap is decent. But when I look at the margins in this report, I mean, I had to double check my glasses.
You saw the negative 11,000%.
Negative 11,490% gross margin. I mean, I know it's a pre-revenue tech company, but that is a scary number. That is a lot of money going out the door.
It is a burn rate that would make a 1999 dot-com CEO blush. They are building factories, they are paying engineers, they're buying Nvidia chips.
And they have very little money coming in.
Almost nothing. They're in what we call the valley of death for hardware startups.
This isn't a stock for the set it and forget it dividend investor.
Absolutely not. This is a venture capital bet disguised as a public stock. You are betting that they can reach that Tesla state revenue positive, scaling up before they run out of cash.
However, despite that terrifying margin, the analyst sentiment in the source material seems surprisingly calm.
It is. The stock advisor lists it as a buy for eVTOL exposure. They cite the potential for market dominance, and they point out that their picks have historically outperformed the S&P 500 significantly, We're talking 886% returns versus 193%.
Past performance, future results, etc. We have to say that.
Always.
Yeah.
But the smart money seems to be looking at the partnerships. Nvidia doesn't partner with losers. Toyota is a major backer of Joby, helping them with manufacturing.
Yeah.
Delta Airlines is a backer.
Right.
These aren't venture firms throwing darts. These are industrial giants validating the tech.
It adds a layer of credibility. It's not just a startup in a garage, it's a startup backed by the industrial complex.
And that backs up the first mover argument.
Yeah.
If Joby is the first one you see landing in downtown LA and you can book it on your Delta app, that brand equity is worth billions.
It's the Kleenex.
Or the Uber effect.
Yeah.
Yeah. You become the verb.
Exactly. If they can become the default verb for flying across town, the negative margins today don't matter as much. Investors will keep funding them if they see growth. But I want to push back on the tech side one more time. We're comparing them to Tesla. But Tesla has had, let's say, challenges with full self-driving.
That's putting it mildly.
It's been coming next year for 10 years. Is aviation actually easier? Or is Joby walking into the same trap of over-promising?
That is the subject of fierce debate among engineers. On one hand, the sky is easier than a road.
Right. No pedestrians?
No pedestrians, no construction cones, no kids chasing balls. It's empty space. It is mathematically simpler to navigate.
But the consequences of failure are so much higher. You can't just pull over to the shoulder if the screen goes black.
Correct. Gravity is undefeated. So while the environment is simpler, the reliability requirement is orders of magnitude higher. That's why the Nvidia Thor platform is critical. It's not just powerful, it's designed for redundancy. It has safeguards built in. But you're right to be skeptical. The timeline for full autonomy could slip. It almost always does in tech.
And if it slips, Joby is stuck paying those pilot salaries for longer, while Wisk might be creeping up on them.
That is the risk. If the Superpilot takes 10 years to certify instead of 5, Joby's burn rate becomes a massive liability. They could run out of runway, literally and financially.
So, pulling this all together for you, we have a company trying to be the vertical integrator of the skies. They're fighting a war on two fronts, against the manufacturers like Archer, who just want to sell planes.
And the robots like Wisk, who want to automate the whole world.
Yeah.
And they are betting that data is the weapon that wins the war.
It seems like the flying car part is almost secondary. It's really a data acquisition strategy wrapped in carbon fiber.
I think that's the most sophisticated way to view it.
Yeah.
The aircraft is just the hardware that captures the value. The value is the operating system.
So if Joby succeeds, they become the Tesla of the air. They own the vehicle, the network, the charging, and the brain.
That is the trifecta. And if they hit it, $9.90 a share is a steal. If they miss it, well, aviation history is littered with cool planes that went bankrupt.
It's a high-stakes poker game. But, it's funny. We started this deep dive talking about how science fiction got it wrong.
Yeah.
But looking at this strategy, using human pilots to train AI, military sandboxes, edge computing, it feels like we've moved past science fiction into something more inevitable.
It feels like industrial evolution.
Yeah.
The future doesn't arrive with a magic wand. It arrives with a regulatory filing, a strategic partnership, and a chip architecture.
So here's a final thought to chew on as we wrap up. We've been focused on the vehicles, but if Joby pulls this off, their most valuable asset in 10 years might not be the planes sitting in the hangars.
It might be the servers.
Exactly. If they have the most comprehensive map of how air traffic moves, how wind patterns affect urban flight, and how to navigate a city autonomously, does the future of transportation belong to the company that builds the best propeller or the company that owns the best data?
In the 21st century, I think we already know the answer to that. Data eats everything.
Something to think about the next time you hear a buzz overhead. It might be watching you just as closely as you're watching it.
Stay curious.
Thanks for listening to The Deep Dive. We'll catch you on the next one.